Enterprise Products Partners has raised its cash payout for 27 straight years. Through 2008. Through COVID. Through the shale bust that bankrupted half its customers. It yields about 6% today, and it's not even the highest in the group. Here's why that's possible: a pipeline gets paid to move the molecule, not to own it. Whether natural gas sells for $2 or $20, the toll is the same. And in 2025, while tech stocks swung on every headline, America's biggest pipeline companies, Energy Transfer, Enterprise, Williams, all posted record earnings. The reason the market keeps missing them is about to flip. Let's get into it. Start with the one idea that explains everything: midstream is a toll road, not an oil bet. These companies sign 5 to 20-year contracts to transport and process hydrocarbons for a fixed fee per barrel or per 1,000 cubic feet. Many are take or pay. The shipper pays whether or not it ships. The giants, Energy Transfer, ticker ET, Enterprise, ticker EPD, Kinder Morgan, ticker KMI, Williams, ticker WMB, run 85 to 95% fee-based revenue. That's the whole point. They are structurally insulated from the commodity price that wrecks drillers. When an oil producer's stock gets cut in half, the pipeline underneath it barely moves. So if the economics are this good, why is this the most overlooked sector in energy? 2 words: K1 form. Many of these are master limited partnerships, MLPs, and they send investors a K1 at tax time instead of a simple 1099. It's more paperwork, it can complicate a retirement account, and most brokers never explain it. So index funds can't hold them, and retail investors skip them. The result is a structural discount. Energy Transfer, ET, yields around 7%. MPLX, near 7.7. Plains All American, ticker PAA, 7.6. The 10-year Treasury pays about 4.5. You're being paid an extra 1.5 to 3 percentage points a year, largely because the tax form scares people off. Now the part that changes the story from income to growth. Artificial intelligence runs on data centers. Data centers run on electricity. And increasingly, that electricity means natural gas. Data center power demand surged 17% in 2025 alone, and the AI slice is set to triple by 2030. Natural gas jumped from 11% of new U.S. power capacity to 18% in a single year. Read that again. The most futuristic industry on Earth, just became a major new customer for the most unglamorous asset on Earth, a steel pipe in the ground. Williams specifically cited new pipeline and power projects in its 2026 guidance. The toll road just got a brand new on-ramp. Let's put the field on the board. By scale, Energy Transfer is the EBITDA giant at around $16 billion, a 140,000-mile network. Enterprise, the quality benchmark, nearly $10 billion EBITDA and that 27-year streak. Then the C-Corp you can hold in any account with a simple 1099, Williams, the biggest by market cap with the dominant Transco gas backbone, Kinder Morgan, the largest gas network by miles, ONEOK, ticker OKE, the aggressive acquirer, and Targa, ticker TRGP, the Permian growth machine. MPLX and Plains, ticker PAA, round out the high-yield MLPs. If you're following this boring oligopoly series, railroads last time, pipelines now, subscribe. Next up, the auto parts retailers that quietly beat the S&P for 15 years. Same depth. Start with the one investors point to as the benchmark for quality. Enterprise Products Partners, ticker EPD, did nearly $10 billion in EBITDA in 2025, with record cash flow from operations of $8.7 billion. Its distribution coverage is 1.7 times, meaning it earns far more cash than it pays out, and leverage is conservative at 3.3 times. 50,000 miles of pipe, the country's premier natural gas liquids fractionation system, and export terminals on the Gulf Coast. That 27-year distribution growth streak isn't luck. It's what a fee-based balance sheet looks like when it's run conservatively for decades. Energy Transfer, ticker ET, is the giant, and the redemption story. Around $16 billion in EBITDA, a record, on a 140,000-mile network spanning crude, gas, natural gas liquids, and export terminals. It yields about 7% with coverage near 1.8 times. After years of a reputation for aggressive deals and a 2020 distribution cut, ET has spent the last cycle deleveraging and rebuilding trust, and it now sits at the center of the NGL export boom, with record export volumes in 2025. The lesson: in midstream, the cheapest stock and the highest quality stock are usually not the same one. ET is the value and scale play, Enterprise is the quality play. Know which one you're buying. Here's how part of the industry solved its own discount: it stopped being a partnership. Kinder Morgan converted to a C Corp in 2014. Targa in 2016. ONEOK in 2023. They give up nothing operationally, same pipes, same tolls, but they issue a simple 1099, qualify for the S&P 500, and open the door to index funds and pension money. The trade-off shows in the yield. The MLPs pay 6 to 8%. The C Corp S, Williams at 3.3, Kinder at 3.8, ONEOK at 4.8, pay less, because you're paying up for simplicity and index inclusion. ONEOK alone has turned itself from a regional player into a 60,000-mile, $57 billion company in 3 years of acquisitions, including the $4.3 billion EnLink deal that closed in May 2025. Now the most striking number in energy right now, and it's a green light for the pipeline builders. In early 2026, natural gas at the Permian Basin's Waha hub traded negative for 25 straight days. Producers were paying someone to take their gas. Why? Because the Permian produces gas faster than pipelines can carry it away. A glut that crushes the gas price is a windfall for whoever builds the next pipe out. New takeaway projects, Kinder Morgan's Gulf Coast Express expansion, the Blackham Line, are racing to fill that gap, a $50 billion plus build-out. The bottleneck is the opportunity. The company that relieves it collects the toll for 20 years. There's one more demand engine, and a policy switch flipped it on. On January 20, 2025, day one of the new administration, an executive order ended the pause on new LNG export approvals. The first new approval came February 14. U.S. LNG exports hit 15 BCF per day in 2025, and the government projects more than 18 by 2027, roughly 30% growth in 2 years. Every molecule exported has to travel a pipeline to reach the coast. Cheniere, ticker LNG, runs the export terminals themselves, the midstream names feed them. Domestic AI demand pulling gas one way, export terminals pulling it the other, and the pipelines get paid on every mile in between. Now the honest column. First, interest rates. These are income vehicles. When treasury yields rise, high-yield pipelines have to compete, and the unit prices fall. Second, the K1 complexity is real. For some accounts an MLP genuinely isn't worth the hassle, and that discount may never fully close. Third, the long-term energy transition. If gas demand peaks sooner than expected, terminal value assumptions shrink, though AI and LNG just push that horizon out. Fourth, leverage and project execution. A badly timed multi-billion-dollar build can strain a balance sheet. So this isn't a free lunch. It's a high-yield, fee-based machine with rate sensitivity and a tax-form tax on convenience. Where does this go over the next 1 to 2 years? Base case, mid-single-digit EBITDA growth across the majors, distribution and dividend increases continuing, with the AI gas and LNG tailwinds adding upside the market hasn't fully priced. Probable, not guaranteed. 3 things to track. 1. Data center gas contracts, watch for named, signed long-term deals between pipeline operators and power or hyperscale customers. That's the AI thesis turning real. 2. Distribution coverage ratios. As long as the majors stay above 1.3 times, the payouts are safe and growing. 3. Permian takeaway capacity. When Blackham and Gulf Coast Express expansions come online in late 2026, watch Waha prices recover and new project announcements follow. Catalysts up, more LNG approvals, AI power gas deals, continued MLP to C Corp simplification. Catalysts down, a rate spike, a demand shock recession, or an LNG permitting reversal. Upstream sit the drillers producing the gas, downstream sit the power plants, the export terminals, and now the data centers. The toll road in the middle keeps collecting, rain or shine, $2 or $20. A sector everyone wrote off as a slow-growth yield trap just posted record profits, shrugged off a commodity collapse, and landed the most futuristic customer on the planet. The K1 form still scares people away. The cash flow says they're missing something. I'm Big Z, follow me, see you in the next deep dive.